50 years ago, a soon-to-be billionaire was up against the property doomers. They said that property prices were too high, supply was a mess, and the economy was overcooked. Sound familiar? But Sir Bob Jones kept investing and grew to become one of the top 10 wealthiest New Zealanders. But what about the anti-property crowd today? Well, these are the top 5 reasons not to invest in property in 2026. And we're going to build the strongest case against property we can in this episode and then give you the counter argument. So, armed with both sides of the story, you could decide if 2026 is a good or disastrous year to invest in property.
So today we are talking about the 5 reasons not to invest in New Zealand property for 2026. Now, this is not to scare you off investing in property. After all, this is a property investment podcast. It's just to say that if you are going to invest in property or hold on to your properties, then you really need to understand both sides, the reasons for buying more and the reasons for not buying more, right? So Andrew, what is reason number 1?
Reason number 1 is that house prices are down and there's no sign of them coming back just yet. Now, what I mean by that is Auckland house prices, for example, they're down still 22% from the peak of the market. Nationally, prices are down 15%. But lots of people can get past the fact that they've come down. But the issue is that they're not going anywhere anytime soon. They're just kind of flatlined. And nationally, if you look at the last 3 years, that's basically it. And when we've got an election coming up and we've got the Trump factor or the Iran war pushing petrol prices up, there's just kind of a lackluster economy and people are a bit nervous. So I can completely understand someone thinking, well, what the hell's the point if they're not going to go up? It's going to cost me every week and it's not going to go up in value.
Well, I think that's a well-made point. But the fact that house prices haven't gone up recently isn't a sign that they won't go up at all in the future. I'll give you an example. Let's say you bought a property in 2007, just before the GFC. House prices went down and they didn't really start increasing in most of New Zealand until about 2013, 2014, before you start seeing much increase at all. So it can take easily 7 years for some parts of the country for house prices to start going up again. Having said that, house prices are actually now more affordable today than they were before the COVID boom because incomes have increased at a faster rate than house prices. And the other thing I'd just say is that although nationally house prices aren't going up, they are going up in some places. In fact, in Invercargill, they are up 22% since the bottom of the market. In Queenstown, they're up 18% since the bottom of the market. In Christchurch, house prices have fully recovered. So even if you bought a property at the peak and your property followed the market perfectly, it would now be worth more today than it was at the peak of the market. But beyond that, I think everyone says that they want to buy an asset, whether it's a house or a share or whatever it happens to be at the bottom of the market. But when the bottom of the market comes, it can get quite scary to pull the trigger because you start feeling like, well, what if it never goes up in value again? And so I think that's kind of the mentality that we're seeing at the moment. But that brings us to reason 2. What's the second reason not to buy a property in 2026?
There's just too much supply on the market right now. So house listings are at a 10-year high. So almost 34,000 properties are listed for sale right now. So that's more listings than there were right at the bottom of the market. So why invest if there's a glut?
Well, I think there's a lot of people feeling similar things with that, 33,000 or so. The one thing is, although it is a decade high,
Yeah.
if we zoom out, back in 2013, 2012, which was when the property market kind of started to recover out of the GFC, there were an extra 33% more listings than we have today. And so it is not unusual, or there have been times in the past where we've had even more listings on the market or even more stock than we have right now on the market, and property's still done okay over the long term. But what I would say as well is listings is only one part of the story, because over the last 3-4 years, we've also seen more people purchase properties. So at the bottom of the market, we had about 56,000 properties selling per year. Now we're seeing roughly 80,000 properties selling per year. So we've got more stock, but we've also got more sales. And one of the things I think people often get wrong when they're thinking about any sort of market is they only look at the demand, or they only look at the supply, and don't put two and two together, but that's actually what causes house prices to either go up or to go down. And so I think you can't only judge a market based on one of those two things. You need to weigh out both factors. And the one measure that allows us to do that is the weeks of inventory on the market. And actually, if we see that, the property market has actually, or that measure, weeks of stock on the market, has been pretty flat actually for the last 3 or 4 years. So we're seeing listings go up, but we've still only got 22 weeks of stock on the market, which basically means that if we didn't have a single property listed for the next, say, 6 months, we'd only have 22 weeks of inventory, which works out to be about 5.5 months. Now, if we look at what that number's been in the past, in the height of the GFC, that got up to over 60 weeks of inventory, and us sitting at 22 weeks. Okay, yep, we've got more listings than we have in a decade, but actually, it's not a with the number of sales, it's not necessarily the largest number ever, right? Like back in 2018, we had roughly around, or 2017, we had more weeks worth of inventory on the market. But if I could go back and buy in 2017, I certainly would, because house prices have gone up a lot since then.
Reason number 3 is that everyone seems to be moving to Aussie. Now, net migration lost to Australia in 2024 was 30,000 people. New Zealand's total net migration dropped under 11,000, so it's the lowest in over a decade since COVID. And the reason people are doing this is that Australian wages are higher, the property markets, they're booming. House price growth in Brisbane and Perth is doing like 19 to 24% a year. It's mental. And Kiwis, they can just pack up and they can move there freely, so why wouldn't they? And if population falls here in New Zealand, well, demand falls as well and prices fall, so why would you buy?
Well, the counter to that, though, is that the population's not falling, it's going up. And that even at its worst, net migration was sitting at around 11,000, so migration's still adding to the population. One of the issues that a lot of the news articles ignore, or I should rather say focus on too much, is just what's the net flow out to Australia. And it's true that you're seeing more people move to Australia than people living in Australia moving here. But New Zealand and Australia are only one very small part of the world, and we're still seeing a lot of other people from other countries moving here as well. And in fact, the other thing that's interesting is you would have noticed over the last probably 3 months, we don't have as many stories in the media about net migration. That's because net migration's increasing again. It's just hit 25,000 and appears to be on an upward trajectory, which means that actually that's not as much of a story anymore. The other thing that I'll just point out, though, is that net migration has been negative for many, many parts of New Zealand history. In fact, if we took you back to like the late 70s, we saw over 40,000 more people leave New Zealand's shores than arrived here, right? Now, if I could go back to the 1970s, late 70s, and buy a house, I absolutely would. And the reason I do that is house prices today are 39 times what they were back then. So an $800,000 house today would have cost about $20,000, $20,500 back in 1979. And so this idea that, oh, well, net migration must be positive or really high for house prices to do well. For most of the 70s, it was negative. For most of the 80s, it was negative. For most of the late 90s, it was negative. In fact, it is only more recently that net migration has been hugely positive. And throughout that time, we have still seen house prices increase. And so I think this is kind of one of the things that's like, okay, there's a bit of a story around it, but people are still having babies. The population's still going up. Losing 40,000 people back in the late 70s when our population was much, much smaller, that means way more than losing that same number of people today, or even the 20,000 we lost during April 2022 when our borders reopened and everybody started leaving New Zealand to get back overseas.
Reason number 4 is the concern around new builds, and the quality isn't that good. Now, 64% of 18 to 39-year-olds say that they think that a new build home carries a high risk of defects. So if you're going to invest and you're going to get over all these other things, well, why would you invest in a new build? Because you're going to buy something that's just going to wear out in the next 5 years. And we've certainly seen this with so many articles, particularly coming out of Auckland, around shoddy workmanship.
This was actually one that really surprised me. And I got called up by a journalist from Stuff who was like, Ed, what do you think about these numbers? Because they seem really high, that 64% of people under 40 feel that new builds homes carry a high risk of defects. Does that surprise you, 64% of people?
It seems very high.
Yeah, I did question about, I was like, Rob, what exact question was asked? And it was about people saying just whether they agree or disagree with that statement around new build homes about whether they carry a risk of defects. Now, we were kind of like that. I'm not surprised that it's above zero, right?
Yeah.
But I would have thought it would have been somewhere around 30% rather than 2/3. The one thing that I'd just say is that this is a survey of people who are much more likely to rent. If you're only looking at 18 to 39-year-olds and the median age of a homeowner is 36 years old, the vast majority of these people are more likely to rent and have probably never bought a property before. So maybe the perception is there, but that might not mean that they've got a solid basis to make that judgment on the whole. So I don't think that shows that that new build homes actually do carry a high risk of defects. I think rather it shows that there might be a perception, especially among younger people who have never purchased a property before. And the reason I make that is not to be dismissive of people's concerns, but just to say that new properties today have to be built to the current building code. And the building code is so much more stringent today around insulation and double glazing and ventilation. Like houses in the 1960s don't have that, right? Like even if I think about, so we were talking the other day, do you remember we did that podcast about noise complaints and about how I was saying that my house is single glazed because I bought an older home because that's what I wanted to live in. And I was telling you that my neighbours sometimes are a little bit raucous because they're in their early 20s. Anyway, they were having a party on Saturday night.
No, don't tell me you went over and then
I did because I was in bed. So I called up noise control and I was on hold. And as I was making my complaint, the music went off, right?
They could hear you.
No. And we thought, oh, maybe they could hear us, or maybe somebody went over there really quickly. No. Then they start singing happy birthday. I think I've just ruined this guy's birthday.
You are such a miserable old prick now.
But if I was at a new build home with double glazing, maybe that wouldn't have been such an issue.
Reason number 5, the final reason, is that yields have fallen. Back in 2003, the average gross yield in Christchurch was over 6%. They were the glory days. Now it's just about 4%. So you've got higher costs. Electricity's up 12.5%. Rates are up almost 9%. Insurance is up. The rental returns over time have dropped. And so your contribution's higher or your cash flow's lower. Gone are the days where you could just buy a property, the rent would come in, it would cover all the costs. You're fine.
Well, I suppose the counter to that is because interest rates have come down from, say, 7% where they were down to roughly around 5%, the top-up that an investor's paying would have roughly halved from what I've seen compared to the peak. And so lower interest rates have made that cash flow gap much smaller. One thing to mention, though, is that the yield, the rental return, is not your total return. So what's interesting is over in Australia, what they often do is they will look at what they call the total return on property and look at the gross yield plus whatever the capital growth has been. So let's say you got a gross yield on a property of 4.5% and property values went up by 5%, then they'd say, okay, your total return is 9.5% before costs. Now, it is true over here in New Zealand that property returns have been lower because property values just haven't gone up. But one thing that's really interesting, I was just looking at this report from Consilium, and what they do, if you guys watch it on YouTube, you're going to be like, that is a lot of color on the graph, and I don't understand what's happening because all of the colors are moving here, there, and everywhere. So what they did was they looked at about 12 different asset classes over time, and they ranked them each year from which one had the higher return and which one had the lower return. So in 2004, it looks like global property had the highest return and global large shares had the worst return. And what they see over time is when they look at it each year is the colors all jumble together, which is just to say that the return you get one year does not predict the return you're going to get next year. So if one sort of asset class, say New Zealand property, does really well for a few years, it doesn't mean that it's going to do very well in the future. From 2004 to 2006, New Zealand property did really well. Then it did very poorly the next year. Then it did okay the year after that. I mean, it only went down 20% in 2008, which is much better than during the financial crisis. Then what was the worst? The worst return was the emerging market shares. It's negative 38%. Then it did poorly. Then it did well again and was right up the top. And it's just to say that returns are often reasonably random in terms of when they go up. And one mistake that investors might make is to say, well, property values haven't gone up over the last 3 years. That means over the next 3 years, they won't go up either. And as we all know, past returns don't accurately predict what future returns are going to be. So let me ask you this. When should someone actually not invest in property?
Well, I think that if you can't tolerate some ups and downs, or you can't tolerate the cash flow long enough to actually see the good years as well as the bad years, then I just don't think it's right for you.
And look, the main point of this is just to say that before you invest, you should look at both sides, right? You should look at both the cons and also the pros so that you can make the right call for you. Now, for some people, the answer is that 2026 is not the year for them to invest. For other people, they might be looking at the market thinking, do you know what? Property prices much lower than they were 5 years ago. There are some markets that are starting, or some parts of the country that are starting to recover and in fact have fully recovered. Other parts are recovering. And so actually, maybe now is the time to invest.
So now you've heard the 5 strongest arguments against investing in New Zealand property, and the other side too. But knowing both sides is one thing, actually building a portfolio is completely another. And that's why you should watch this video next, which is my boring blueprint to make 10K a month through property. Click the video on screen and I'll see you in there.